And our top story is the U.S. economy, because the first reading on first quarter U.S. GDP came out on Thursday morning, and it did not look good. Growth for the first 3 months of the year stands at 0.5%. That is slightly lower than economists' forecasts of 0.7%. It's also lower than the previous quarter, when the economy grew 1.4%. Let's get more on this with Karina Huber. Karina, good to have you on set with us. So a lot of numbers, but the most significant part of the GDP pie, consumer spending.
Absolutely, because of course consumer spending accounts for about 7/10 of the overall economy, the growth. So what we look at when we look at the GDP numbers really is the personal consumption expenditures, and this is what we learned about them today.
U.S. consumer spending for the first 3 months of the year was up 1.9%. That's lower than the 2.4% gain in the earlier quarter. The things Americans shied away from are big-ticket items like automobiles and washers and dryers. Durable goods sales fell 1.6%. The drop in the pace of spending comes despite low prices at the gas pump and an increase in wages. Economist Steve Blitz says Americans are now saving more because they aren't as confident about housing as they once were.
People can't presume that the home is going to give them the return on investment that's going to generate the savings to support retirement.
Another negative, business spending contracted at its fastest pace since 2009. Low oil prices are mainly to blame. Profitability at energy companies has plummeted, causing them to pull back on capital spending. The Federal Reserve has indicated that it believes the U.S. economy will bounce back in the second quarter, but Blitz isn't convinced.
When we look forward to the second quarter, I don't see the seeds for some great surge in growth, some great bounce back. Now, that's not to say growth can't improve in the second quarter, but it's not necessarily a given that it's going to.
Over at the New York Stock Exchange, reaction to the GDP data was relatively muted, in part because there were no major surprises, in part because the data is backward-looking when investors like to look forward. In some ways, though, the negative data can be viewed positively in that it lowers the odds the Federal Reserve will raise interest rates by next June, something the market tends to like.
Traders like Peter Costa think the market will be in a holding pattern for the near future.
You know, the way I look at it is we're probably going to have a very, very narrow trading range for the next, I'd say probably 2 or 3 months. I mean, you know, we'll have our swings here and there based on what happens overseas, you know, if there's any kind of geopolitical event. But, you know, as far as like the bias in the market, right now the bias is probably neutral.
Now, with the first quarter behind us, the next major focus for the markets will be the jobs report, which comes out next week and will give us a better read on the area of the U.S. economy that is growing, the labor market. Michelle?
Karina, you mentioned the labor market, some positive signs there. What were some of the other bright spots in the GDP report?
Okay, well, with the labor market, essentially, we're seeing that unemployment claims fell to a 43-year low, which is pretty remarkable. Also, we're seeing wage increases. The other bright spot in the report, though, had to do with housing. We saw that there were substantial increases in spending on constructing new houses as well as renovating existing houses. So 2 positive signs. Whether this will be enough to overcome some of the other challenges, of course, remains to be seen. We'll find out in the second quarter.
Another upside, wage growth up 2.3% year over year. So not all bad. Thank you so much, Karina Huber.